speaking with Joe Unwin, Head of Portfolio Management at Apostle Funds Management. And Joe, first off, thank you very much for attending and participating in the Inside Network's Investment Leaders Forum.
No, thank you for having me. It's been great.
It's been a pleasure having you. Joe, in credit markets, investors are often drawn to higher yields, but of course not all risks are being rewarded equally. So how should investors assess whether they actually are being adequately compensated for the credit risk they're taking?
Yeah, I mean, credit's all about reducing risk, and high yields are only so good as long as you get to keep all of that yield. If you're investing in things that are going to default, your yield's going to be eroded and the high yields weren't worth it in the first place. So yields should always be viewed relative to the risk you're taking, and the best way to reduce default risk is to invest in parts of the market that have structurally less downside risk. They're generally alternative in nature, but they offer high yields with much less risk, and it allows you to sleep easier at night.
Those certain segments of the credit market that you're talking about offer attractive returns with structurally lower default risk, but what characteristics define those opportunities and why are they often overlooked?
Yeah, so I mean, the reason that there are some parts of the market that offer high yields despite having less risk is usually two reasons. First of all, they're generally alternative sectors, so they're not as well understood by the markets. So they generally attract additional risk premium. And secondly, they often have really high barriers to entry, so that prevents capital from flooding into them and pushing yields down. There's a couple examples would be things like infrastructure credit, alternative parts of real estate debt, even bank loans. They're not areas that every manager can invest in, and that prevents capital from flooding into them and pushing yields down.
Specialist expertise is really critical in alternative credit investing. What should investors look for in terms of the fund managers that operate in that area when they're looking to allocate to what is quite a niche area?
Yeah, so if you're investing in alternative credit sectors, you want to be investing with the managers that are the best in the world at investing in that sector. So it's not going to be the really big names that cover all parts of the credit market. It's going to be niche managers that focus on that sector and they're the best in the world at it. So they're likely to have a long track record of proven success at avoiding losses in that sector, and that allows you to sleep easy at night.
With ongoing interest rate uncertainty and inflationary pressures, how should investors think about using floating rate debt and other structures that offer risk protection?
Yeah, so the benefit of floating rate debt is that it has no interest rate volatility. If bond yields go up or down, you don't get any price change in floating rate debt. So if we go into another year like 2022, where bond yields skyrocketed and bond prices were down, say 20%, floating rate debt wasn't impacted by that. So whilst you can, of course, make positive returns on the fixed rate stuff as well, ultimately it's all interest rate volatility, and floating rate debt completely avoids that. So in a higher interest rate environment or an inflationary environment, floating rate debt offers significantly lower volatility.
Looking ahead, what do you see as the biggest challenges and opportunities in private credit markets, and how should investors look to position their portfolios to balance return potential with the need to have the risk managed?
Yeah, I think the biggest challenge in private credit is transparency and investors being able to understand the risk of what they're investing in. The easiest way to navigate that is to invest in really sophisticated markets like the US market, where they just have much higher transparency standards. So for example, they have something called the North Carolina ratio that measures the health of a private credit manager's portfolio. That's the kind of metric that isn't available in smaller markets like Australia, and it gives you confidence that when you're choosing a manager, you actually have look-through data to understand how risky their portfolio really is, and it doesn't have to come down to your own judgment.
Joe Unwin, Head of Portfolio Management at Apostle Funds Management. Thank you very much for your time.
Pleasure.